Hey guys, I was just gonna draw the same kind of Elliott waves on the Nikkei bubble as I did on the financial crisis, or on the sorry, the S&P Everything Bubble. And I had my whole model set up here on the Nikkei, but I guess I lost it. So I just put the labels in. I'll just go ahead and draw these lines. This is Brian Lewis with MMT Investing, and things just changed. Okay, so here on the Nikkei, we have the analog of the dot-com and the financial crisis, and then you can get a bull market trend line here that goes up and cuts through all this action on the bull market, and then you can see it tops that pattern there on the backside of the bubble, and then similarly, if you come off of here, you can get a bull market line that comes through the whole Nikkei and hits all these reactions up the whole Nikkei bubble. And then you see that the crash crosses across the bull line, it dives beneath it, and then it sets up a steeper trend line here. And then if we get in closer, we can adjust this thing so it's nicer. That one's pretty good. And here is the Volmageddon crash of the Nikkei, and that goes up and does our dead cat bounce just like we did on ours. So we have the same three trend lines as we do on ours, and you can see where they come from. They're not arbitrary, they're not straight. They're long-term bull market lines, and this one crashes below and gets steeper, this one crashes below and gets steeper. So we get three steeper and steeper trend lines, and then when we blow the bubble top, here's the Nikkei blow off top, and we break it and backtest it, and then break it and backtest it, and break it and backtest it. So that's how you get underneath these trend lines. You break them, backtest them, and then reverse out of here. And I'll just start drawing some Elliott waves. So this is a pretty obvious one. There's the 1, 2, 3 wave here, or sorry, it's a ABC corrective wave off the top of the bubble. And then on the higher level, if you do the Ray Dalio cycles inside of cycles, you can see the waves inside of the waves here. So there's a 1, 2, sorry, ABC corrective wave here on the higher level. And then if you go on the lower level, you'll see there's one here. Draw that a little bit better. A, B, C on the small level. And then you can see that the A is the middle of the larger one. So see this bigger one here, our A wave cuts that one in half. It's the tangent line that cuts that wave in half. And then you go A, and then B, and then C. And then if you take a look at this, we had 5 waves on our bull traps underneath our lines here, and they have the same here. 1, 2, 3, 4, 5 with the double top, and then 1, 2, 3, 4, 5. Try to get cleaner lines. 1, 2, 3, 4, 5 with the double top here. And then if you zoom in here, you can't see it because I can only get to daily candlesticks on the Nikkei. But this bull trap on the Volmageddon would be similar. 1, 2, 3, 4, 5 with the double top. And just imagine it. And then, let's see. What else? I guess hit that like button to help me out with the YouTube algorithm. And that's pretty much the model. If you want to get more specific on the waves rather than just saying it's a 5 wave or something and look at what it's actually doing, which is the similar pattern as to what we're getting on the S&P everything stock market crash right now, is that we get a dead cat above, then we break it and back test it immediately, And then we get our double test. And that is the exact pattern that we have been getting on the S&P every time. And it's part of this kind of 3-wave and 5-wave pattern underneath these same consolidation lines. And you can't see on the smaller scale here because I can't get down to tight enough candles. But it's the same thing here. You do dead cat, break it, back test it, and then you go out and you get your double tops. And those double tops are what made me start realizing what was going on the S&P model. And then I did the cup, is this a cup or is this a double top video after I realized all those double tops. And that is the general idea. And the same thing that I said in like the last 10 videos, probably before I even realized that the Nikkei did any of this stuff, before I even saw this Nikkei chart, was just that pattern, that repeating pattern where we get the dead cat break back test, and that's what we would be looking for on the next chart. And if you compare this one to ours, these type of bull market these type of bull market lines are the same type of lines, but they're not spaced out exactly the same as ours. Like the amount of space here in between their long-term line and their financial crisis line is much smaller on ours. And for instance, if you their timeline is slightly tighter. Yeah, so let me go over the timeline. So our crash, these lines are spread out farther, and our crash came down farther percentage-wise, and then did the same kind of thing. And then this line is not quite as far down on ours. It's closer to our line here. But if you squeeze the timeline in, it's pretty close. The wave patterns are really close, and the support patterns are really, really close. And that's cool. And then I guess just to show you something else that I've pointed out a bunch of times is, so if you zoom out and you look at this big wave pattern, that's kind of the big corrective wave that undoes all of these bull trap line or the bull market lines on the whole bubble. Once you get that bigger wave, the ABC, that undoes the whole bubble basically. But that's not the floor. That's not like a mean reverted bottom of the bubble. That's like undoes the top. That's like the blow off top of the bubble. And after that, you get more normal activity. But you can see in this range, this is 27 to 20 kind of range. So let's say like 24-ish area during the crash. And then people say that this thing trended sideways for a while, 20 or 30 years. And that, I mean, it does look relatively sideways, yeah. But if you get in here, here's where it actually bottomed and reversed. It's at 7. So that's not sideways. 7 from like 24 or something, or 22 is not sideways. And then it starts reversing, but it's never gotten back to the bubble highs that it was in the Nikkei bubble. So I mean, that was a 20-year bear market that it blew off in about a year, and then it took 20 years to get from this 23 area down to 7. And that was the lost couple of decades or whatever they call it. But yeah, it's not sideways. 24 to 7 is not sideways. That's definitely down. And that is one idea of how the backside of our bubble will look in terms of just the blow off top. But this bear market, I mean, if you look at the Great Depression, it had a similar blow off top and a recovery just like this. And I guess I should point out where we are on ours. We're here. We're underneath the financial, or we're actually on top of the financial crisis line right now. We're right here in our pattern, and we're looking down at the Volcker line, and it's not as far to our Volcker line as this Volcker line is, but that's the next move off of the reversal of the double top, is looking down to a dead cat bounce. And I've mentioned, I mean, I had a dead cat video like 2 weeks ago that was way too early, trying to figure out these repeated pattern moves before I realized the double top and the 5-wave kind of shape that we were doing. And so that's the Nikkei versus the S&P with the same bull market lines that we have on ours. And that's just kind of the way that bubbles shape up. I mean, they just get steeper and shorter trend lines until they blow off, and then you unwind those trend lines, and it just kind of follows these patterns. But I was gonna say, like, getting from this sort of correction down to the mean reverted bottom that was at 7,000, like 20 years later, like in the Great Depression, we got from this point down to the bottom in like 3 years. So, I mean, it could be the bear market after the top blows off could be 2 years, or it could be 20 years, or I don't know. I don't know how to predict the following bear market. But these waves off the top unwinding these bull market lines, you can kind of predict those and see what's going on. And we'll see. I mean, it should be. Oh, and let me talk about the timeline. So our timeline's a little bit wider. Theirs started at the beginning of January and ended in October. So it was almost a year. And ours is a little bit wider, so it probably should be a full year. And I was projecting this top of this bull trap to be right around our presidential election, which is in October. Like, this was July here in October for them, but our timeline's a little bit wider already, and we started towards the end of February, so we could actually run to around October here, and then around New Year's, maybe to the end of the year on this down, or maybe into the next year, just on the cycle, kind of repeating rough math. But yeah, so, and also it's good to point out on this that that the down leg is shorter than the width of this thing, and the reversion height is about half. So that's pretty normal. I mean, it bounced about halfway, and it's a little bit wider than the down. So that's the same thing that we're seeing in ours. And I think if we see the next move down that breaks our Volcker line like this, people are going to freak out. And that's going to be nuts. And then we're going to be riding this thing towards the presidential election. It's going to be absolutely insane if we're coming into an election out of this thing. And then if we have another one to go after the election. So that's the timeline, and that's the Nikkei. And also Japan, this is a really good model, not only because the waves and the support levels really fit well and match, and the back testing works the same as it's working in ours, but also because Japan is one of the world leading central banks, world leading economies, and their central bank was doing quantitative easing. Like, they're the pioneers of quantitative easing. They were doing quantitative easing and intervention the whole time during this whole bubble crash and unwind, and it didn't do anything to change the shape of this lightning bolt ABC wave to unwind the top of the bubble. But maybe the quantitative easing did drag the bear market out for 20 years instead of doing it in like 2 years. But speculation, I don't know. Just for the most part, I completely ignore the news and anything that people say, because it just follows a mathematical pattern of the monetary system. It's a derivative, a mathematical derivative of the expansion of the currency. And once you hit this point where the currency can't expand any farther, then you start getting this contraction pattern, and that's what the backside of the bubble is. This is just it's a monetary expansion pattern that gets steeper, and then you hit the max expansion here. And I've said that that's kind of when like the backing on the currency is no longer good. Like when you printed too many units for the backing and you start getting like a run on the banks and that sort of stuff, where your collateral is no good anymore. This is when you get these reversal points in the bubbles. I've looked at a lot of bubbles and mentioned that, um, but it doesn't really matter why. It just matters that it happened and that it follows this pattern, and that's what we're looking at. And we'll see. We'll see what happens. It hasn't happened in our chart yet. I mean, we're just here, and everyone thinks that we're just going to go to all-time highs from where we are. So let's see. Let's see what happens. Thank you, and please hit the like button. This is not investment advice, and this, I guess, is my Japanification number 4 video. I may as well name it that. A Japanification Elliot Waves. And the Ray Dalio cycles inside of cycles with Elliot Waves. Very cool stuff, guys. Very, very cool stuff. Hope you enjoyed it. Happy trading.